Ladies and gentlemen, good evening. This is Christopher Aaron from iGold Advisor coming to you with a special interview today. We have Francis Hunt of themarketsniper.com on the air. Francis is a technical-based trader and investor. He focuses on a variety of markets, and we're here to get Francis's opinion on several important markets that are impacting our work. Francis, welcome to the show.
Chris, delighted to be back with you.
Excellent. Francis, the first thing I want to ask you is a bit of a macro type of picture here, a macro question. We see here in the United States, there is a new Fed chair that's been nominated by President Trump. That is the Fed Governor Powell. We see overseas in the Bank of England a rate hike, recently the first rate hike in 10 years, raising interest rates to 0.5%. And an interesting stat that I've just learned is that the interest rates over in England, even at 0.5%, are actually lower than they were in World War II. This also goes for the Great Depression. So, in your opinion, Francis, what does it say about the state of macro affairs in the world that interest rates are still lower and have been held lower for the last 10 years than they were in the deadliest conflict of human history? What does that say about what is happening in the world today?
Wow, yeah, excellent quality question, Chris. And of course, also worse than the Great Depression years that you alluded to as well in terms of history. In other words, we are writing new economic history, certainly in terms of how monetary policy has been brought about in the UK. And I would say this is broadly the case in most of the major Western economies and even those that are not Western. My take is deemed quite a radical one. And the only reason that they are at the level that they are is because of the nature of what we went through in a combination of 2008, which was a part response to the action that was taken post-dot-com boom. And it's been my assertion that we are in a depression. An economic depression. Now, people will say, well, that doesn't add up. I'm doing good business. I still got a job or whatever the case may be. The definition for a recession, most people know. Very few people actually are familiar with what actually constitutes an economic depression. So a recession is 2 quarters of negative growth. Many of your viewers will already be on top of that and be aware of that. A depression is essentially 2 years of negative growth plus systemic banking failure. And in actual fact, if you look at seeing as we're talking about the UK and UK interest rates, but for 2 quarters where there was marginally like 0.1% growth, the UK had 2 years of contraction. And in actual fact, those quarters which actually had a non-negative numbers, and of which, as I say, there were very few, and it was ever so marginal. This was post the effects of a quantitative easing, which was the greatest proliferation of new money ever to have occurred. So if you had not had what can only be described as extra normal economic activity, we met the criteria for economic depression. Ronald Reagan used to joke, a recession is when your neighbor loses his job and a depression is when you lose yours. But the actual definitions that do exist for recessions and depressions, those are them, and systemic banking failure. And we had all those elements. And in fact, if they were allowed to run their course, in other words, the fire had run through the brushwood and cleared out all the old debris, we could have had the famous political green shoots well on the way now. All we actually did is we postponed the detoxification of a broken system for another day with even greater levels of what went before. So hence you get all the people referring to, drug taking analogies. I'm not a massive fan of that. So the fact that there isn't a recovery that doesn't have a normalization of monetary policy. There's nothing normal about monetary policy at all anywhere in the world right now. In other words, it is the most extreme accommodative monetary policy you can possibly have for a time frame that spans that of just an emergency band-aid for a once-off strike crisis that should see a very strong response. I mean, this is hospital ward. This is life support. In the hospital ward. It's not even the general ward. This is life support, and you don't leave bodies in a sustained area in life support. You switch a machine off. Because it's quite clear that there's nothing to resurrect. And this process has been stymied on the no pain economic central banking cartels policies of sustain the banking system. The mistake everybody makes is thinking that the central bankers work for them. The central bankers work for those people that gave them the power in the first place. And this is why it's not in your benefit that we have this zombie economy. It is a resurrection for those that would have been directly affected, and that would have been the clear out we would have had in the banking system. And that was never allowed to occur. So that's an extreme view, and many people don't accept it. But, it go by definition, and that is it. Take the external forces and abnormal measures that were taken to keep the people alive. And I sometimes jokingly, one of the most popular movies of the 90s was Pulp Fiction. I sometimes jokingly refer to, the Uma Thurman injection with the insulin, I think it was insulin, straight to the sternum. She was dead and gone. That was just a major spike me up to just prevent the heart from stopping. And we had the equivalent of that. It wasn't a normal emergency. It wasn't a bit of bad flu. This was, preventing the heart from stopping. And we've since been morphine addicted ever since. That's my take. And as I say, it's not to everybody's taste. But in terms of definitions and economic history, as you've already pointed out, the greatest world conflict, an entire recession in the depression of what was accepted as depressions. My view is depressions largely only get called depressions retrospectively anyway. It doesn't serve people to tag a depression because that's a psychological, self-fulfilling and mindset-based aspect. You need people to spend, go. So it's a word the media has avoided like the plague. They've come out with, green shoots. We were hearing the usual green shoots phrase that I've already alluded to, within a year or two of 2008 or 9, but nothing ever normalized. Monetary policy never returned to the 5 or 6% it was before. And the key reason why it can't is because the levels of debt are simply way too high, both from a government perspective, who took on a lot of the toxicity that was brought about by the banking system onto their own books. They won't be able to pay. It would trigger an immediate default. And the banks themselves. So we are actually in a padded cell right now, and those walls have been closing in. And, it's time to retire. And eventually what ends up happening is if you don't make that decision, it gets enforced upon you. And then it'll be called a black swan event by the likes of Greenspan, as he did the 2008 event all over again. And there's nothing black or swanny about it. It's on the cards. It's run its lifespan. And, it's time someone pulled the plug, because we all want to get on with a clean sheet, the truth be told.
Great analogies there. I know that scene well from Pulp Fiction, as you were speaking about, and the padded cell analogy. I think this puts it in an excellent perspective for listeners. So we have this unprecedented situation happening here in the world with the central banks, and it's not just one central bank, but it's around the world. Yet at the same time, and I think this is sometimes what's difficult for people to grasp, at the same time, we do not see the skyrocketing types of moves in the precious metals that I think a lot of the fundamental based analysts have predicted over the years. We've seen this decline since 2011, coming into the lows in 2015, something of a basing process that is setting up now over the last several years. So I just wanted to transition into the precious metals themselves. From your technical work, Francis, where are we with the prices of the metals? No one can predict the future with 100% certainty, but what are the high probability outcomes that you see based on your technical work that fits in with this model that we're discussing of the central banking?
Yes, good question again. My view is still bullish and remains bullish on the recovery of precious metals. And you might know or remember that, unfortunately, I was quite a strong bear for a sustained period when it was in the technical position of setting up continuation patterns and trading lower. So I'm not what I'd call perma bull or bear. I'm never for someone marrying an asset class, a share, an equity, or cryptos for that matter, and all tend to occur. So the truth is always in the charts. Those are the footprints in the sand for me in terms of being the tracker of what people are doing, not what they're saying. And actually there is grounds for conservative optimism. This is not a market that I anticipate to go runaway. And what's happening for a lot of precious metal people is that there's been clearly a diversion created. And I don't want to over talk about this topic because it's away from your audience, but the crypto market does seem to be a very good diversion for gold and silver bugs. So what you have is libertarian type money that is being diverted away from maybe its natural home and gold. I think that might be certainly a reason that some resources are going into that avenue. The other reasons why it's maybe been a bit slow and a little bit frustrating is that which is spoken about, such as the ability to create derivatives in and around an underlying market. And I've often done, the simplistic explanation of derivative markets as I bring a cock and you bring a cock to the cockfighting evening, and I bet you £5 or $5 that mine is going to kill yours, and you shake on the bet, and then the whole village comes to watch the event and has a bet with the local bookie, and we end up having hundreds of thousands of people betting for and against each other through the local bookie on the outcome of that fight. The actual underlying market is a fiver between the two of us, but the derived market on this event that is created by the audience that are all looking for a reason to gamble or speculate runs into a multiple hundreds of thousands of times. And to me, that's how control structures control underlying markets. And there's no doubt in my mind on balance of probabilities that is a mechanism. Derivatives are a mechanism to overarch an underlying market. So you probably have had, to a degree, I think it's largely accepted, disproportionate derivative effects in the gold and silver markets by most people's assessment of what's going on. And, when you look at who can vault and who can do bullion, there's a magic circle of people that can play in that game. And you and I aren't in that club particularly. So all sorts of vested interests can then manifest. And the concerning thing for people that think that cryptos will be allowed to go their own way as well is that while the CME announcement caused a big pump on Bitcoin, that they'll be creating futures markets, etc., it will also become in time a market that will have a derivative facility over it. And this is, in my view, how control structures end up controlling the end game. They don't actually like disorderly markets. Disorderly increasing is as bad for them as disorderly decreasing markets. And rather than things going up, they like them to move slowly and in a concerted fashion. So they claim to be a stabilizer. The Fed and the central banks are meant to be, or their brochure, the glossy brochure that comes out, is meant to be, they have a stabilizing effect on economies. You and I probably have a slightly more acerbic response to that strapline in their brochure in terms of the degree. And in fact, since 1913 and the creation of the Fed, they've done nothing of the sort. In fact, the markets have got further volatile. So they've created cycles. And when you create a cycle, you know where to position to best benefit from it. And you take the educated, or the inside narrative takes away from those that aren't part of that narrative. So it's very powerful to be able to create the tides, the ebb and the flow. And so there's a reason why it's probably been slightly frustrating. I can tell you, technically speaking, because that was your question as well, that we have gold right now against the dollar. It is still in an upside HVF. That is my methodology that people can find out more about in their own time on the website you mentioned. But we have what's called a time stop. In other words, we have a projection forward into the future by when we would consider the setup as invalid or too late to hang on to, and the juice is no longer worth the squeeze. So we work on both a risk to reward based technical elements, but also we include a time frame. So we're the only methodology that I know of that has RRR divide T. We're interested in how much juice do you get? How much are you risking in getting that amount of juice? And at what time frame should it have performed by? Because even if you have a 10-to-1 trade, there's no point in waiting a decade for that. You could have had many other investments that may have compounded faster than that. So I've just got the chart up in front of me right now, Chris, and I'm going to give you my call date for when I would invalidate this pattern. And the patterns that are high probability, that means they're more likely to perform than not. And our target when we last spoke, I gave to you on a setup, was up just shy of the 1500s. It's 1491. Now,
Yes.
if I look at the time frame that I've got, we've got until August 18 to make that. So, you're talking about the best part of another 10 months for that to happen. We had a nice move. So the break point for us, our midpoint was actually the 1240 level. We broke from there quite nicely. We had a great little run up. It ran up to our first interim. By the way, I'll share this chart because for many people just listening to this orally, it might be a bit difficult to follow. But if they know their charts quite well, we deemed a break in July of this year. On our methodology. We ran our first interim level, which was at the 1330. And very shortly after that, the gold topped out at 1358. It came a large way back, which is probably what has frustrated many people. Charts don't and trades don't go up in straight lines. Even breakouts don't. Everything rests. And what you had is you had a dip back down to the 1259 levels. Then you had another smaller bump that took you to 1300s. And now you're basing out. And actually today we're trading up. And recently there's actually been quite some outlier volume. I'm looking at the date of the 3rd of November, and on the data that I have here on the chart, it was quite a substantial volume day, and the market traded up on that day. So it seems like you've got a bit of a floor now at the 1263, and I would say, stay loyal to the setup, and you have your time frame for when you're looking for just shy of the 1500 levels, which could, of course, clear the 1500. So our target is they have to be run at that level. That doesn't mean it stops on the dot. This is not an exact science. It's a geometry based on a volatility squeeze, and it's a very good place typically to take a rest. So if you were slightly overweight, you could possibly go back to neutral for a while on gold post running that target that I just told you about. And as I've said a number of levels, I'll just confirm it again, 1492, which does point to probably a finger over 1500 at some point before August next year. Before the end of August next year, because the date I had was in August. So, you've got a bit of waiting around to go. You've got to do your maths there and say, well, we're at 1265 now. That's another, roughly $250. What percentage return is that? It's about 20%, isn't it? Is it 20%? I think I'm just about right, 20%, and it's about it's about 10 months to get it. So then you could probably take off a little bit off the table and hope to pick up on a little bit of a pullback after that. So I'm fairly happy with this chart and how it's performed, but it's not a ripper, and there's no getting away with the fact that a few people might be feeling a tad anxious. Remember, it's the trader's dilemma. The minute you take off, the market can move against you. We've had a big volume day on the 3rd. We're basing out. Sometimes it's set and forget is the safest thing. You have your stop loss in the market if you're trading. If you're investing, it's less critical. And you have your take profits in the market if you're using leverage and trading. And in that can make 20% in 8 months a little more interesting if you leave it up conservatively, let's just put it that way. Don't be trying to shoot the moon and bet the farm with other people's money.
That target 1492 is quite close to the range that I've been looking at for some time. I've been giving a range of 1485 through 1535. I believe, I don't have my chart up at the moment, but I remember the last time that I looked at it, the 1535 was very close to the 50% Fibonacci retracement level of the entire down move, that 1923 down to 1045. So I think we have a confluence of targets that we're both looking at in that upper 14 and lower 1500 level. But you gave a good analogy, and this brings me into the last topic that I wanted to ask you about. We're talking about this period. It's also working in with the season that we're coming into. There's a period of rest here, the winter season. the precious metals have been in this period, this grinding period where it's not the hottest market in the world. There's a bit of a rest going on, but something is shaping up. Something is developing underneath the surface, if you would say. And so I wanted to ask you, Francis, a bit more on a personal level. When you're spending so much time looking at these charts and you're spending time dealing with certain markets that are hot right now, the cryptos are hot, other markets that we're gearing up for maybe over the course of the next year or so, how do you balance that? How do you balance the action, the quickness of the action, the intensity of the action in the markets, and especially when things are not going your way, let's say for a day or a week or several months even here. We've seen these grinds going on in the metals. How do you balance that with the other aspects of your life? Let's talk just a little bit about maintaining some sort of physical health, mental health. You could even say spiritual health, but I don't want to put a label on that. But I wanted to ask you personally, how do you balance this trading with the other aspects of your life to maintain a healthy outlook in the world in general?
Yeah, it's a very quality question again, Chris. And the key elements I think that you're touching on here are balance. It's something that in each aspect that you've mentioned, you've said the word balance come through a number of times. Becoming a successful trader is not a sprint, it's a marathon. It's not any one little spurt of activity that's going to make you as a trader. It's the culmination of a sustained process. Also added to that, a solid methodology, consistency, and a fairly emotionally balanced approach. And we're fortunate in terms of what we've done. We've got our mindset, our methodology, and our markets pretty well brought together. You need to have all three. It's kind of like three overlapping circles in a pyramid almost, where you've got to be in that intersection that includes all three. If you're not, you've got some searching still to do, and there's resources out there for you to consider. But what I would certainly say is we use the acronym Lifestyle Trader, and I try avoid the traditional guy in his Bermuda shorts lying on a lilo in the Bermuda somewhere with his laptop on the beach somewhere. That's a little bit of the tacky selling the sizzle kind of guys. But Lifestyle Trader means integrating that which you do in a manner that it doesn't take over your existence and your relationships with children, family, friends, your relationship with health, as you've mentioned, like working out, your hobbies, etc., etc. So rather than you taking on this new thing that turns into a Pac-Man and morphs who you are, and you go into the 9-monitor, 3x3, 14-hour days, adrenaline-seeking, thrashing around, which actually is something I've done and was counterproductive for me and for most people in my personal observation. You actually need to integrate that into your existence. So it can't become something that dictates. It's got to be something that fits in. And the only way I find that is successfully done is if you have a methodology where you have what I call set and forget parameters. In other words, the entire trade idea, especially where you're using leverage, for example, those that are investing, there's more of a buy, hold, carry on with your day, and it's slightly more accommodative. But when people are, if they don't already have a few $1 million, they're needing to work there and they're using a bit of leverage, etc., and they're wanting to make some gains. You need to have a point at which you engage the market and a very powerful reason. So we have what we call our HVF method, and we trade the squeeze. Incidentally, there's something very similar to that setting up in silver right now, and that's particularly exciting for your audience, and it could be a trigger for a move. And you might want to check your gold-silver ratios as well. If we have time in this interview, I might be able to get up a chart for you on that. But essentially, we trade. So we trade that squeeze on the basis of what comes next. If you are a reactionary, you are then always chasing the pump of a move, and you are panic buying and panic selling. So the minute you are a reactionary, you have to be tied to the screen and you react with a herd. You become the 91%. That is a road of mediocrity. What you need to do is determine criteria which gives you an early heads up to a future possible event. There is no absolutes or guarantees in anything in a market. And we've determined our criteria, and we have a method for that. So we trade the very low volatility events to high volatility events. We make sure they're continuation patterns, so we don't focus excessively on calling tops or bottoms, in other words, reversals. So we are always following the larger flow of the money. So you need to remember that this global planet is all these buckets, dishes, and cups pouring water from one to the other. You pull a lever, some tilts over, and there's flow from one area, one geography, one asset class. The big money can move anywhere in the world, and you want to understand where the money flow is. And once again, as I always say, I don't listen to what people say. I look at what they do, and the way you do that is the God's handwriting on the wall. If you remember the parable, or the footprints in the sand, that's the tracker in us all, and that's where you get volume and pattern. And those are the most reliable things that come out of technical analysis. And there is quite a bit of stuff that largely is theory for theory's sakes out of technical analysis, and it's made a lot of people a lot of money just selling indicators and lines and mathematical formulas. There is no insight or clairvoyance in most of the indicators. Where there's raw data like volume and volume by price, which is a histogram that runs across the chart, I can see where the primary skirmish is taking place, whether it's a support point or whether it's a resistance point. It gives you an insight as to how the pattern, the direction of the pattern may move. This is the level of technical analysis we go in. So with a method, with a reason, you're then expecting an abrupt move. You can get tight if it's a low volatility event. That curbs your risk and limits it, which allows you to trade a larger size for the same allocated loss. So we set about with an allocated loss that is predetermined. So a $10,000 account might be $100 at 1%, it might be 200 at 2, or 150 at 1.5. And you don't spend more than that. Write the check, pop it on the spike. That's what you've done. You're paying to play. And that's the worst case scenario. And that risk to reward, the reward ratio must be interesting enough to be well beyond what we would consider 2.5. We like 3s, 4s, 5s, 6s, and we often get primers, and we have double-digit rewards. So we've landed a 62.5 risk reward, and I keep looking for that opportunity to do 100 to 1, and I've yet to succeed in it. But it's a lifelong striving point, because it'll be very satisfying. But focus on the right process and the right dynamics, and be consistent in the pros. You are never rich on a single trade. The problem with early traders is they trade for a Ferrari trade. They want to go quantum leap, and it's all going to happen in one macro event. And this is what I call the sizzle, the adrenaline. They all just want a quick hit. You grow with your portfolio as a person. You are not going to adapt and grow. When they give people, we had people on welfare checks win the lottery. They give all that money back after a massive splurge, and they end up penniless again and back on welfare within very short time span. I'm very well aware that I'm not talking to a bunch of people on welfare checks, but the point is we all need to grow and your P&L and your account. So you mentioned spiritual levels. Grow with your ability to manage resources. Money, far from evil, is actually proof of service or proof of well-managed quality decision-making, not quantity decision-making. And that is the beginning and an essence of a spirituality. So recognize all these elements, seek to grow at those levels, and recognize it's not a sprint, it's a process. The more you stop focusing on money and you focus on good, solid, founded process, the more the money flows. Chase money and it runs, chase process and it comes. And this is the game. So rather than trying to hit a 6 or knock a home run into the stands, this is just getting to first base consistently, getting to second base. Nobody ever got sacked from the New York Yankees for always getting to first base. To use an American analogy. And so that is the game you play. And to do that, you actually need active breaks. Because the game is very much like in the Mowgli movie and the anaconda with the eyes that turn, that hypnotizes the young boy. The game is very capable of sucking you in with adrenal effects, psychological effects, all sorts of elements and leverage. It always gets emotional. And then you go to device, fixing to your device and, having a meal with your wife and checking your phone. These are all indications you're being sucked in. The anaconda has hypnotized you and is pulling you in. And it's a precursor to a wipeout. So it's like a spiraling in. Think of that, those currents that spiral in. It's not a good place to be. You get sucked down 40 feet under the ocean. So the point is, you've got to respect the markets and keep it at a managed distance so that you don't get drugged. We're all potential. You don't have a little bit of cocaine, in that sense, if you'll excuse the analogy. Or so there's some people that are alcoholics. You can't have a small little drink. So you've got to you respect the market's pull force on your psyche and recognize you need to keep it at a distance, and you just have your rules for engagement. And now if you have a process and you say, I will enter at that level, my stop is predefined and my take profit is there, and now I accept I have no more power over this process. Wisdom is recognizing that which you can affect and that which you can't, and submitting to that which you can't, and recognizing that and saying, I can't control which direction the market will, but it's done a certain amount of things that gives me a higher than usual probability that it may do X, Y, and Z. And if it is to do that, that is the point where I will enter. That is the point where I'll have my stop loss. And that is the higher, stretchier reward that we should get. And this is why we snipers. We aren't running around the jungle in Vietnam with a Uzi spraying the jungle. You're about to get killed. You're selective. You specialize it. You're a specialist. You're doing one thing exceedingly well, and most of it's in the preparation, the observation, and the patience. And if you do quality, good decisions, you have a 1 in 3 kill rate instead of a 450,000 rounds expended for every kill for an average infantryman. So decide: are you going to be what level of efficiency do you want? Do you want to be the sniper that is essentially a special force guy, or do you want to be a grunt? An everyday grunt in the Vietnam jungle, keeping heads down, making a bit of noise to keep a hill, and then when you leave, the enemy take it back. There's a function of efficiency there, and so look at all of those elements. And the physical realm is where you get your great creativity, and you get your break from the continuous stream of charts. What tends to happen is you don't recognize change if you have a continuous stream. There'll be listeners that have kids. It's always your friends you haven't seen in a while that say, wow, how your kids have grown. You've watched this increment by increment on a daily basis and haven't noticed. They've got a snapshot from 3 years ago when they last saw you, and now they're seeing them again. In essence, you need that with the market. In other words, the night begets day, the breaks beget productivity. If you are continually you're attempting to sprint the marathon, and you are not seeing the scenery change. You're not spotting the enemy because it's become a blur and you're in a daze. You can't be hyper-focused and continually hyper-focused. And this is the other reason, and the wisdom behind our methodology, is that we broadly watch lots of markets. When we get something that is giving us a lot of what we're looking for, we then drill down. And that's the point where you go hyper-focus. And just before triggering event that we refer, which also has a bit of a military connotation, we are hyper-focused, and then we drop timeframes right down. And then every twitch is significant. In most instances, every twitch is not significant. For most people, now is not the moment. So if I said 3 things that will make your listenership greater traders, I would say do these things. Never mind. Let's say you hate me and you hate my method and you don't want to hear or find out anything. Here's 3 things that you can do that will make you a more effective trader in any market, including gold and silver. Number 1, reduce the number of your trades by 3. If you do 30 trades a month, do 10. If you do 10 trades a month, do 3. If you do 100 trades a month, do 30. That's number 1. Number 2, always have a pending order and be taken away when you're not on the screen. Be taken into the trade when you're as likely to be away from the screen. I want you to be out there living, riding motorcycles. I've just come back from riding through the desert in the Western Cape through Sutherland on this beautiful plateau. That's what freshens you up. That's that break that gives you the productivity and the ability to focus. Go do that. Go live. Be taken in on a pending order. Cease to utilize market orders. Market orders are random entry. That means you've had your coffee and your cereal, you've switched your computer on, and it's now 9:30 in the morning, and you've decided, what am I doing? I'm a trader. I'm going long today. That is what I call random entry hypothesis. In other words, do your work, decide what's a key level that needs to be taken that will imply a new momentum, a new force in town, and be taken in by the market. Have a predetermined stop and target that was done prior to all of the events then materializing. So if you cease to enter on market orders, and every order you now enter is a pending order, you will improve your trading on that one alone immensely. You've also cut your trades by 3. And the final one is we always go for high reward to risk situations. So manage and know your risk rewards. Always have a target. So I kind of covered that in 1, 2. So I'll recap these 3 points because I've merged them a little there. Always have a target and know your risk to reward, and know the check you've written for playing. Every time you enter in the market, don't get numbed to this fact. You're going into the sea. There's predators there that can take you out. Write the check for the maximum you're allowed to lose. You don't want to lose a leg. You're not here to lose 30% of your account. You're here to lose at maximum a moderately sized small percentage of your total equity. That allows you plenty of opportunity to recover if your methodology has any form or justification. So those 3 points again: cut your trades by 3. Point number 2, only enter on pending orders. And the third one, have the entire trade concept predetermined by your stop and your take profit also being OCO entered in the market. That means, and this comes back to the lifestyle element and how do you incorporate in the life, because you asked one question and I've covered a lot of topics in this. This means Chris doesn't need to be standing in front of his computer. The order will be triggered if he's playing tennis, racquetball, at a game with his friends, switching off for a while, leaving the charts, spending time with his son, wife, daughter, fill in relevant relationship of great meaning to you. That means you're at your yoga class. That means you're in your physicality. So you are as good as your weakest link. If you are toxic and an alcoholic, doesn't matter how good your methodology, your mindset, and how zen you are in the yoga class, if you're a drunk, you're going to fail. So you need to be relatively good in all those areas. So health does matter. If I could take the 5 worst trades I've ever done in my life, they invariably always involved a point where I had very little sleep, too much coffee, or even maybe slightly hungover, which is not an occurrence really for me anymore at any level, but in the early days, or some element, or a fight and an emotional fallout. In other words, there's anger and vibration still in you, and you've got to come to the market clean. Come to the market clean and respect. You know, you're preparing for war. You don't go to fight a battle hungover, toxic, and without your weapons. You need to think about that. So show up ready. You know, the guys watch the UFC. Those guys prepare. You know, they want to minimize damage and they want victory. They're on out drinking the night before. And that in trading, it's like that. It's financial damage that's at stake and financial reward. Don't show up sick. Don't show up toxic. Don't show up with headaches. Don't show. So if you're doing all of this, this points to a balanced life. This notion that, you know, there's these guys that are very successful traders and they have a cocaine habit. That isn't them. That's brokers, man. That's guys that are controlling flow. That's a different paradigm. You need to be a well balanced. This is a spiritual journey, trading. This is, I say to everyone who does my program, you've signed up to become a better trader, and there's a subterfuge plot in all of this. You want to be a better person. You're going to need to be, and you're going to challenge yourself, and the obstacle is always the way. The thing that keeps sticking you, I was highly emotional. The thing that keeps sticking me, I needed calmness. I needed to get my personal volatility lower than that of the market participants. That's when you can game. If you come more volatile, more FOMO and fear of loss than the people that are participants, and this is a professional market with a lot of institutional, intelligent, bright people you're trading about. So you got to show up balanced and calm. I've spoken for a while, but I hope that there's a lot in there that can support you guys. And the trading must be integrated. So you leave it on and go do the other things that you must do. Have another pursuit. Over fascination begets underperformance, almost always. So the minute you've been on the screens too long, and you start getting fat and you've been sitting all the time, you're doing yourself a physical damage and you're starting to eat away at the other things that are meant to be kept in balance. And you use that word balance, and you're spot on with that.
A lot of excellent points in there. Thank you, Francis, so much for that. The set and forget, or the integration into existence, I think that's such an important point that you touched on. Having this flow, having this be something where you are growing with this as a process. I know that's something that I myself have fallen into traps of not being able to do that in the past, and something that I really strive to do now in this part of my career. On that note, I am heading up into the woods later today up in New England here, and spending a few days with my dog and my father up in the woods, and taking a break from the computer screen. I will keep one eye, of course, on what is happening if there's anything of critical importance that happens, but the active break, as you mentioned, and living with the process, having it be something sustainable, I think that's something that I know is something that I must keep at the forefront. It's challenging at times, because there is so much emotion when there's money at stake. It is quite challenging for us as human beings, I think, but some of these processes are really important that you've highlighted upon. So probably what I'll do is put a little summary of some of the things that you've said in the text below the interview so that people can reference some of these points quickly off the bat. Francis Hunt has been our guest today. His website is themarketsniper.com. And Francis, I really thank you for your time. Is there anything else that you'd like to say in closing as we leave the listeners here at the end of this interview?
Yeah, probably just a short reiterate. Those 3 points. It's the principles of sniperdom. Less is more. In other words, the minute you cut volume, you improve quality. You spend more time. If I say if I give you 5 little sticks and each one represents a trade, and I take one away each time you put a trade on for the month, you're going to think long and hard before you hand one of them over to me. And that means there's going to be more thought. There's going to be more 360-degree analysis looking at the intramarkets. So do that cut of volume. Do that pending order. It's a lesson in patience. We want to be in the game. It's called compulsion. It doesn't feel like a trader to not be in the market. Put your order on, walk away. You're not in the market. It feels like you're not playing. Learn that patience, that the market tells you when it's ready to move. And if you're in the system, you get filled first. You're not one of the fear of missing out chasing afterwards once it's already moved 5 or 10%. You planned it, you put it in, and the system takes you in. Even if grid goes down and you're walking your dog with your dad in the forest, you're in before everyone else who's sitting on their backsides getting piles and staring at their screens, losing their eyesight. And that's preparation. So the quality use of your time for quality decisions, letting the market confirm your probability of your scenario cost is occurring. And then that third one, always know at a business level, we don't buy in an item as a supplier or anything and then not know what our margin and our potential retail price is. So this is a business. Have an idea. What's your probability of outcome? How much will it cost you if you're inaccurate, and how much will you make if accurate? Then you start to have the makings of a methodology. That's built into what we do, and we're very happy with our methodology. But, I'm one man of, there's many ways to skin a cat, and I'm not going to say we think ours is the best, but of course we would think that. We think we've got logic to prove it, but of course we would say that. But have those 3 components in whatever it is you do. The sniper gets 1.3 while everyone else gets 450,000 per kill because he is a specialist. He does all his preparation pre-trade. By the time he pulls that trigger, he's just about sure in his mind. And it's not any shot. It's not maybe he'll hit. It's a headshot. It's just a question of, what square inch takes the bullet. And it's fatal. He's got, the perfect tools for exactly what he does. So become a specialist, not a generalist in terms of what you do. And yeah, love to all the silver and gold guys. I'm glad you're out there. I love that kind of audience. I'm part of you. I want to just say to you, the market is looking a bit better. I'll tweet out on your Twitter handle in conclusion a silver chart where I think that there's actually going to be a little bit of a squeeze up, quite close to our methodology that we like. So if anyone wants to just have a look at it, but own your own trades, terms and conditions, all the usual stuff. Be your own man and make your own decisions. But thanks for having me on again, and just love to all your people. And I'm looking forward to coming statesides, by the way, and maybe get in touch and we can do an event or something interesting. And if the guys would love that, just let them shout out to you about that.
That's great. Yeah, absolutely. I look forward to that. And I'll post the links to the charts that you're referring to. And I look forward to seeing you on this side of the Atlantic. We can have a little event and perhaps get some people together if there's anyone going to be in this area. Francis, thank you again for joining us. Have a great rest of your day.
Absolutely. Lovely chatting, Chris. God bless.